Okay, peeps, welcome back. So today we're going to be going over the macro markets overview for May of 2024. This gives us the 10,000 foot view of how things look in the macroeconomic perspective, which does apply to the financial markets. So with that being said, let's get it. All right. So you guys know how this goes. We do this once a month. We don't need to know every single detail of every little thing like the jobs report and stuff like that. What we're trying to gauge from these videos or what we're trying to show you guys how to gauge from these videos is kind of the overall conditions of the market and whether things like bullish or bearish. Okay. This just simply pertains to being able to make money. We don't need to know every little detail of everything. Okay. So let's start with the SPX. As you guys can see, we broke out of this channel. We broke bearish. We have recently bounced and closed above this downtrend line. So that's a very good sign. I would say that's actually very bullish. So it kind of looks like we had a fake out, but maybe. I mean, it's not entirely it's not entirely played out yet, and I'm gonna tell you guys why in a minute. So you guys can see that every single time we've broken out of one of these wedges and or channels, we've had some kind of drop in the markets. We saw the most recent one last year. We were covering this with you guys last year. We told you that we were looking for a breakout, and we thought it was going to come down a certain level. We were taking a look at the 200 simple moving average on the weekly time frame and a lot of that stuff. So the more important thing I want to point out to you guys is we have a triple bearish convergence here. So we have a MACD death cross, an RSI death cross, and also a close outside of this channel. It doesn't necessarily mean that it has to go down and sell off a lot or for a long period of time. No, not necessarily, but I just do want to point that out to you guys as potentially an early warning sign of a downtrend or some kind of correction here. So far, we've had from top to bottom roughly about a 6% correction. Again, this thing could come down as far as this zone, which is about 46 to 4,800. There's no guarantees, though. It doesn't have to do it. So it is riding nicely on the EMAs. We got to close above the trend line. So pretty much what we're looking for here is a close back inside of the channel. Okay. If we can get back inside of the channel or form perhaps even a new channel, like something like this, then that would be good. Okay. We want to see that in order for the bullish momentum to continue to pick up. But in terms of a recovery, I mean, this is a pretty strong recovery. So you're not going to hear any complaints from me. You know, if asset prices are going up, we're happy about it. So SPX looks good. Excuse me, kind of a very similar theme on the NASDAQ. So triple death cross going on here. And again, a breakout of the channel. Pretty much every time we saw something like that before, we did see a massive sell-off. So I'll show you guys a few here. So you got one here. And you have one here. We usually only draw this out for the SPX, but you guys can kind of see where I'm going with this. And every time we get one of those breaks, there is some kind of sell-off. So no guarantees if this thing has to go up or down. We're just basing this on probabilities. But as of right now, the SPX has already broken bullish out of the downtrend. The NASDAQ has yet to do it, although this candle right here is a hammer candle, so that's very bullish. So in terms of the NASDAQ, we are expecting the NASDAQ to go up next week. So support is currently about 16,000 to just shy of 17,000. In terms of the pullback here, this was a little bit deeper, which is not surprising because, again, the NASDAQ is more tech focused, whereas the SPX is more value focused. You know, your old kind of staple companies like Procter & Gamble and Walmart and PepsiCo, those are kind of your S&P 500 companies, whereas the NASDAQ is more like Amazon, Tesla, stuff like that. So not a surprise on the bigger pullback. We did not even come down and test this zone, which I'm kind of surprised. We might, but again, it doesn't look like that's going to happen. It does look like it's going to go up. So NASDAQ looks very good. Once again, you got the triple death cross here. Well, not triple death cross, but you have the MACD and the RSI having a death cross, and potentially the EMAs might too. So Russell 2000 is looking a little bit weaker. We got to break out of this rising wedge. We did confirm it. Now we're coming back to retest both the previous support, now turn resistance, and also this trend line. So if it dumps, we could stop at this EMA, which is 1930, or we could go all the way down to 1810 at this trend line. And again, the trend line is a very long time frame trend line here. I believe this is actually, yeah, this is pretty much about accurate. So we have two different trend lines here, as you guys can see. Excuse me. So Russell 2000 looking a little bit weak compared to the NASDAQ and the SPX, but that's not surprising. So we'll have to keep a lookout for that. And the Dow Jones, again, we did kind of a little bit of a breakdown out of this, but it looks like it actually wants to go back inside the channel, so that's definitely a good sign. Again, the support is going to be about 35.8 to about 37.1. And in terms of the drawdown here, we had a pretty good sized drawdown, about a 5-6% correction. And again, a technical correction is defined as 10%. And a bear market is defined as, well, basically a correction is anything from 10 to 20%, and anything beyond 20% is considered bear market correction, or basically a bear market period. So it's above the EMAs. We had the death crosses down here. It could be an early warning sign of a potential further downtrend, but I'm not seeing that on the charts. So these could possibly be fake outs. As far as I'm concerned, all of the indexes still look very bullish. The only questionable one here is the Russell 2000. Again, this is made of small and mid caps. So, with the Fed funds rate being at all-time highs, it's expensive for these smaller companies to borrow money. It's very expensive, and it's hard for them to pay it back too when the interest rate is so much higher. So everything still looks very bullish on the indexes. We did think that the sell-off was going to be much steeper on the SPX when we saw this breakout. We posted this on X for you guys, but apparently it's not to be so, and it makes perfect sense because we're only 6 months away from the presidential elections and the midterms. And for those of you guys that say that don't matter, oh, don't talk about politics, guys, the reason the Federal Reserve was brought into inception was because of a president of the United States. These things matter. I can tell you right now. Okay, we've been studying this for a long time. We know exactly what we're talking about here. So, the president of the United States and Congress, they affect everything in finance. Okay, anything from antitrust lawsuits to tax codes to whether companies have to get broken down or not. You see all these, I mean, guys, you can see it for yourself. You see all these hearings with these tech executives like Mark Zuckerberg and Elon Musk and all these other guys having to go before Congress and answer questions. I don't think I need to say more about that. You can look it up in your own time. But now let's go over to the stocks above the 50 and 200-day moving averages. So we'll start with the NASDAQ. You guys can see we got a massive, monstrous bounce here. So that's a very good sign. It looks like the bottom for the stocks above the 50-day on the NASDAQ might be in. But, there's no guarantees. I mean, it could go lower. These things are kind of very volatile and it's hard to predict. What we're kind of looking for here is the ideal buy zone would be in this green box. The ideal sell zone or selling for profit and or shorting would be up here in this red box. And you can see the occurrences are pretty rare right here. So it's only hit the red box 5 or 6 times basically in the last 4 years here. And it's only hit the green box like 7 times in the last 4 years. So this thing is still looking cheap, I would say, which means that, compared to where it was back here in January 2024, stocks do still appear to be a much cheaper, more affordable buy at this point in time. So stocks on the 200-day moving average on the NASDAQ. This one looks, I don't know, it's kind of in between. It's a little bit more expensive, but again, if it's not sitting all the way up here, I would consider that to be cheap. If you're worried about it, I mean, I suppose you could DCA it down as this thing comes down to the green line, if that's what you think is going to happen as a way to kind of hedge against downside. That's something that we also implement, but it's up to you guys what you want to do. So stocks above 50-day moving average on the S&P. You guys can see once we got this bounce from back here in October 2023. It just went absolutely insane. This thing just ripped. It didn't even care. So we kind of see like a buyer wick here. This could indicate potentially a bottom, but there's no guarantees. And again, the green box is the ideal buy zone. Red box is the ideal sell zone. This is for more of short to midterm, like perhaps swing trading or investing for anywhere between like 6 to 12 months. This would be the indicator that you would use for the 50-day. So kind of in no man's land on this one, not bullish, not bearish, just kind of stuck in somewhere in between. 200-day moving average. This is more for very, very long-term investors, kind of more like your, 1 to 5 years, something like that, or longer. So you can see we've only entered the red box again on the S&P just twice in the last basically 6 years. That was in April and May of 2021. So that was actually the mid-cycle peak for Bitcoin. So we've been in the buy zone 4 times, 4 times in the last essentially 6 years. So it is a rare opportunity. We're much closer to the top than we are the bottom. I'd say that's a bit bearish, but again, the markets are not showing any sign of weakness. Excuse me. So the yield curve is still inverted currently. Usually when uninversion takes place, there is a massive market dump. Again, whether that's going to happen or not, we don't think it's going to happen because, again, when the Fed was raising rates in 2022 and 2021, there was a bear market. That doesn't usually happen when the Fed it doesn't usually happen when the Fed raises rates. It usually happens when the Fed cuts rates that we see the market tank. So basically what I'm saying here is I think the market's already priced in the bear market back in those years. And when the Fed cuts, the markets are going to start shredding to the upside is what I'm telling you guys I think is going to happen. But again, we won't know till we know. So everything still looks the same on the yield curve. The thing that I would say is the most concerning is the fact that yields are going back up again. That's a little bit concerning. That's not really what we want to see. We want to see the rates come down and stay down, but we're just not seeing that yet. So, I mean, the reality is the Fed can only keep rates so high for so long before eventually the government can't afford to pay their bills, and they have to. And the Fed has to start cutting. They don't have a choice. So, how long it's going to be before they have to eventually, have to capitulate and give in is just a question of time, but we'll have to see on that. So again, Fed funds rate, as you guys can see here, the FOMC meeting was recently. This didn't change. And inflation. So we had a small tick up on headline inflation, no tick up on core inflation. That's really not what the market wants to see. The market wants to see both of these come down to be super bullish. Why does that matter? Because if these come down, then the Fed is less likely to hike rates. Okay. Basically, if these go up, the market will start to get scared and sell off because they're going to assume that because inflation is not going down, that the Fed might have to hike rates to keep inflation under control, which the Fed did not do, thankfully, but that is a concern. So we don't want to see this keep coming up. We want to see it go down. Again, demand destruction has to take place for this, which means that people need to stop spending money like crazy. But of course, you know how consumers are. They just love spending money. So the unemployment rate, this is one that we have been kind of talking a little bit more intensely about. So we're kind of seeing the unemployment rate start to slowly move upwards. This is a little bit concerning. I'm not going to lie to y'all. So we kind of don't really want to see this thing go up. We want to see it stay the same and or fall down, kind of like here, as you guys can see, stay the same, but definitely not go up, because once this thing starts to go up, as you guys can see, it looks kind of similar to this right here, what we're seeing currently. At some point, this thing really starts to take off to the upside. That's when the Fed has to cut rates. Unemployment goes up. I can tell y'all right now, it's not a guarantee, but there's a likelihood that we might see another drop in the markets, okay? That goes for crypto and stocks, because if there's more people that are unemployed, there's less people that are making money. Therefore, there's less velocity of money, which means that less people will have money to be able to go out and spend. And that's not good. And that will force the Fed to cut rates because, again, they broke something, so they have to come and fix it. So this is kind of something we're looking out for. I would say if it gets beyond the 4%, then we're going to start seeing some real bad stuff happen here. Hopefully we don't see that. But again, we'll just have to keep an eye out on it and see what things look like going into the future. Excuse me. So now we're going to talk about oil prices. So, yeah, I don't want to be on the monthly here. I want to be on the weekly. So oil just recently had a massive drop, as you guys can see here. In terms of whether this is a bearish or a bullish trend, I mean, it does not really look like it's bullish or bearish, to be honest. If I'm looking at the chart as it is, it looks like it's kind of sideways. It's just consolidating. It doesn't really know what direction to go yet. So it did kind of get a rejection off of the zone here, as you guys can see, between 80 and 84. So it was basically a pump fake. It went up, busted out of the zone, and then got sold off. So based on this big red candle, I would say likely it's going to come back down to at least $76, if not $72 to $74. But and we do trade oil in the futures markets, but keep in mind we're just trading it. We don't really care if it goes up or down. Okay, we just care about making money on it. But in terms of the oil prices itself, in regards to the markets, oil prices going up is inflationary. So if this is coming down, that's good for inflation. That means inflation will drop in the energy sector. So now let's go ahead and go over the metals. So I got to switch these time frames here from weekly to monthly because you guys already know how we do this. So yeah, looks like I'm going to have to draw some zones in here again. So basically, well, I don't really need to draw zones in for this one. You guys can kind of see it. So gold is all at all-time highs at 2308. I would say if this thing is going to find a support, it's probably going to find some kind of support roughly around $2,000 or so. Again, you kind of have these wicks here. This was a big breakout point, as you guys can see. So we draw these lines up here, and once we kind of got out of that zone, I mean, this thing took off. So if it does come back down to retest, it would probably retest at 2,000. If it gets below that, I say probably going to stop at about 1780 to 1830 most likely. Gold's very expensive right now. If we were going to buy gold, we'd buy it in smaller amounts. We're not going to buy huge amounts while it's so expensive. So silver, again, in terms of the overall channel here, a little bit more expensive. Top of the channel is about $30. Bottom of the channel here is about $17.70. If you want to pick these candle tops, you say maybe 20 and a half. I'm kind of just drawing a line sideways here. You can kind of see what that channel looks like. So silver a little bit more expensive. Me personally, I'd be waiting for it to get to the bottom of the channel. But if you think there's going to be a major economic collapse, maybe it's worth it to buy some precious metals. That's entirely up to you. So platinum, still looking relatively cheap, but again, we would not want to buy it unless it gets in the zone. So that's 694 to about 833, and the sell point up here is 1175 to about 1325. Palladium, we have been waiting for a very, very, very long time for this to come down to support, and I mean years at this point. So support is about $900 to $1150. The resistance is just shy of 3,000 to about 3,400 up here. So you can see from the current point, just to get back down to resistance would still be a nice drop. So it'd be about 37%. But if we manage to pick this up at support, and assuming it ever goes back up that high, it's potentially a 250% gain. So this is in terms of the metals, this one's very cheap. So copper is going through the roof. That indicates an increase in demand because, again, copper is a very industrialized kind of metal. It's used in a lot of different stuff. So big green candles here, which tells me that demand destruction has not yet taken place and the economy is still strong. So the fear and greed index, as you guys can see, we are in overall fear territory here, which means ideally For those of you guys that follow Warren Buffett's advice, buy when others are fearful, sell when they're greedy, right? This is the ideal time to buy dividend paying stocks. You can kind of see the different metrics here. So, junk bonds, greed, safe haven demand, extreme fear, which is weird because the precious metals are going to highs. Market volatility, not much going on there. Puts and calls, kind of neutral. Stock price breadth, meaning the overall market, not just the tech sector, kind of a little bit fearful. Stock price strength, extreme fear. Again, we did just have kind of a pullback in the markets, about 6%. We don't know if that's over yet, but it does look pretty bullish as of right now. So market momentum, again, in the greed territory, but that makes perfect sense because we've had some pretty strong moves up over the last 6 months. So 2 more things we're going to get into here before we close this out. It's going to be the DXY, which is the dollar index. Again, this is the US dollar. So US dollar strength is still going up. We're right in this trend line here. We used to say that Bitcoin was not going to have a parabolic run until the dollar went down, but obviously that's been negated because of BlackRock and those other guys behind Bitcoin. But I would still argue that a crypto bull run would be better if the Fed was printing money versus trying to suck the supply of money out of the system. So what I'm saying right now is we're in a QT bull market, but it would be better for all asset classes if we were in a QE bull market. Again, we're in quantitative tightening. It'd be better if we were in quantitative easing. So the dollar, again, still looks very bullish. We want to see a break of the trend line and the support zone. We have not had that. It's a possibility it could go back up to 112 to 114, but we would need to see a break of 106 to get that. And on the VIX, we kind of had like a little fake out here. As you guys can see this wick. But again, the VIX is still not really doing much of anything. Fear has not really entered the markets. So anyways, this is our 10,000 foot view on the markets. Hope y'all enjoyed this content and it helps in some way. Please like, comment, and subscribe, and we'll see y'all later. Peace.